When it comes down to managing risk as a futures trader or as a trader in general, it's like really one of the simplest things. Why? You just need to win more than you lose. Okay? And we're not talking about trades because you could technically win more trades than you lose and lose money. We'll get into that. But you just need to make more money from your winning trades than you lose from your losing trades. And however you get there, it literally doesn't matter as long as you can repeat that over and over and over throughout weeks, months, years, and maybe even a lifetime. Where everyone gets tied up in the how do I manage risk as a trader, as a futures trader, there's really not one way to do it. And if we came on and said that there is one way to do it, we're not actually going to help you. And so by the end of this video, the goal is to give you a clear-cut plan, strategy that you can follow and implement in your own trading. You'll know exactly what you need to do. Then it comes down to you just going out and doing those things to manage risk and to become consistently profitable over time. That's the goal. That's the goal for all of us. And you can't sit back and relax because a lot of the past mistakes could easily come back and haunt you. And so it's always a game of constantly improving, or at least staying on your toes so that you don't let these past mistakes or poor risk management strategies creep into your trading. Now, I'm super excited to dive in because I think we've got a really unique way of approaching this video that's actually going to be helpful. And I think it was really helpful for me when I started thinking about things this way. And so I hope the same for you. But first, I do want to thank the sponsor of today's video, Jigsaw Trading. Jigsaw Trading offers traders an edge in the markets through powerful and intuitive trading software. With advanced tools for order flow analysis, visualization, execution, and advanced analytics and trade journaling, Jigsaw Trading gives traders a real-time view of market activity and helps them make better informed trading decisions. Whether you're a beginner or an experienced trader, Jigsaw Trading has something to offer from their starter package to their professional package. Plus, their team of expert traders is always available to provide guidance and support. Take your trading to the next level with Jigsaw Trading. 14-day money-back guarantee. Try it today. Thanks for Jigsaw for sponsoring today's video. All right, awesome. So the first piece here is data, however you want to say it. We need a couple of things to be logged. We can't just come in and start saying, all right, how do you manage risk? Well, yeah, you can go and look up the videos. Oh, risk 1% to make 2. And yeah, that sounds great, but that's not like, okay, cool. But that might not be what makes sense for you. Okay? It might not. So like those types of videos and that advice is great on paper, but it doesn't really apply to everyone, number one. And number two, it might just not apply to your strategy. And if you think you must do it this way, you could be selling your strategy short. So we had a video, I believe we had a week ago, and it was like 5 things you need to know before you get into futures trading, something along those lines. By the end of that video, you've got a pretty nice step-by-step plan to get yourself started. And towards the end, we talked about technical analysis, trading strategy, and then keeping it systematic. And why that's so important is because you need to have a step-by-step plan. If this, then this. When I see this, I do this. Boom, boom, boom. The boxes get checked. Here's the trigger. I take the trade. Okay? Now that we've done that, I want you to track those trades. Whether you use a free tracking software, whether you use a paid tracking software, or whether you just simply log the trade in Excel or on a Word document. Take a screenshot after the trade, take a screenshot before the trade, whatever you want to do. Take some notes down, but you got to log the trade. And what I want you to do is I want you to tag setups. I don't want to give hard advice as to what you should do in terms of what you should trade, because you can trade anything you want. But you probably don't want to trade 37 setups. I was that guy. And guess what? It was extremely complicated. I had no clarity when I was looking at the market, and I couldn't really track if I was profitable or not because some things were blending over into this setup and some things were blending over into that. So defining 2 to 3, I don't go more than 5 to make this easy. You can expand later on. Ideally, in a perfect world, it's 1. It's 1 setup. It's 1 strategy that you trade. Break out this dip buy based off of this indicator. I don't know if you want to use that, you could. If that works for you, great. But once you have tracked your strategy and can tag trades based off your strategy, and now you've got data, as in 10 plus trades, the more the better, but like 10 plus trades that fit your setup strategy or system, if you will. Now we can make data-based decisions off of that. And here's where we can start to play. We need to track our win rate and our R multiple. R multiple essentially is how much are we making per trade? How much are we losing per trade? Okay? If at the end of 10 trades, we recognize we have a 50% win rate and a 0.9% R multiple, that's telling us we're losing money. Why? Because a 1 R multiple means I make $1 for every dollar that I lose. A 1.1 means I make $1.10 for every dollar that I lose. And then of course that can be scaled up, right, with sizing in hundreds of dollars, thousands of dollars, whatever, etc. But that's what we need to get into first. What is our win rate and what is our R multiple? And again, the R multiple, pretty straightforward. If we have 10 trades and let's say out of 10 trades, 5 are winners, on average, we average out the winners. The winners come out to be average of $50 or $100 or whatever the number is. And then we say, okay, what's our average loser? Let's say we average a $100 winner. Our loser's average is $100 as well. Boom, a 1 R multiple. The higher above 1, the more profitable or the better risk reward we could say that our system is presenting. And then the lower, below 1, means that we're losing larger on our losses. Now, we could still be profitable there. We'll get into that. But the reason why we need to start there is because now we've got a baseline to go off of. If you don't start there and if you just say, oh, I need to risk 1 to make 2, or I always need to risk 1 to make 3, because that's what many people will tell you, you don't. You don't. You could risk 1 to make 1. You could sometimes risk 1 to make 0.75 if it's a very high probability, right? Again, like you could be profitable if you're winning 9 out of 10 times and your R multiple is 0.9, 0.85. You're still going to be profitable. Don't worry. It comes down to what fits your trading better. Okay, so now that we've got those 2 things, there's really 3 ways to go about managing our risk. We can improve our win rate, we can improve our R multiple, or we could do both. And I think a combination of both is where we all end up kind of falling into, because I think we always strive to improve the win rate and we always strive to improve the R multiple. So you kind of are like looking to do both, but like realistically, you don't have to do both to become better, manage risk better, and become profitable, right? So now that we've got a baseline, what are some ways to improve the win rate? Now, one of the things that worked best for me was taking less trades. Less is more, as they say. It's not going to work for everybody, but the reason why it worked was because when I was taking less trades, I was more selective. The trades really checked all the boxes that I was looking for and met my criteria, hit my trigger, boom, I took the trade. Many times you'll find that you'll be taking more trades if you normally take, between 1 to 3 trades a day, or some days maybe you don't take a trade because there's just no setups. That's possible, right? And when you really narrow in, your strategy, that's actually likely, because there's some days that just are not going to align with your strategy. That's fine. You just don't trade. Like, no big deal. Some weeks might even, right? But when I took less trades, right, I was dialed into the best of the best setups. For example, I had about a 55% win rate in the month of June, which netted not a great profit factor. It was a profitable month, but not by a ton. But go back a month in May, I took like half the amount of trades I took in June, and I had a 66% win rate. So again, seeing those 2 things back to back was like, yep, that tells me July, we're going to take a lot less trades. We're going to be more selective. We're not going to try to take 7 trades a day. Another thing to improve that win rate could be avoiding times of extremely high volatility. For example, for me, that becomes the open. When the market opens, we see a lot of volatility. So I take the first 15 minutes off. So actually, I'll use that first 15 minutes sometimes. Like if I get to the desk late or, if I'm busy, I was at the gym or whatever, I'm making breakfast, sometimes I'll come to the desk and I'll be like, okay, I got 15 minutes to chart my levels out. And then, 8:45 Central Time, because the market opens for 8:30 for me in Texas, then great. I come to the desk, I check things out, mark my levels off. Here's what I'm looking at today. Is it this market? Is it S&P, NASDAQ? Is it oil? Whatever. And then here are my levels. The next thing you can do is adjust your strategy. And this is also a piece that is important to do as well. I think is very valuable. Is now that we've traded a strategy, you're going to have this data to say, okay, maybe our stop losses can be put higher because we're recognizing that the trade breaks down many times once this level breaks or this level breaks, not all the way down here or all the way up here where I usually have my stop losses. So you can journal that through tracking your trades, taking pictures, screenshots, looking back, recording your trades if you wanted to as well. Add that to your own journal. Maybe it's the trigger. Maybe the trigger point is a little bit late. You're kind of buying in a little bit late. You're entering a little too late. Those are all little tweaks that can be made to improve that win rate back deeper into the strategy. But please, 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 everyone gets caught up in this. It doesn't mean we need to switch strategies right away. Okay? After 10 trades, you have a 40% win rate, you have 20% win rate, and you're like, oh, this strategy sucks, I can't trade. No, it doesn't necessarily mean that. It's only got 10 trades. Trade it for a month. See what happens at the end of the month. Log some more trades, make some little tweaks and adjustments, see what you can take away, and see if you can kind of take maybe a simple strategy, add a couple little things, a couple things that you now need to check the box before you enter, and that could take a simple strategy that maybe doesn't work and now turn that into a consistently profitable strategy that gives you an edge. Now for the R multiple, again, we talked about like you could technically have a sub 1 R multiple and be profitable. Ideally, we want the R multiple 0.9 or better because it's going to make the game a little bit easier on us. We start dipping down below 1. Okay, now we got to have a better than 50% win rate, which is not that insane to do. I think that 50 to 60, even 70 are doable numbers. Like, let's be honest. But when you see traders posting their 95% win rates, that's where it becomes a bit skeptical. Okay, that's not to say that it's not possible, but it's possible over select time frames, but over the longevity of a career, over months, years, right, decades. Let's be honest. You don't need to do that. It's not very easy to do. And if you were, you'd probably be at a hedge fund and you wouldn't be on social media, right? Probably. So take that with a grain of salt. But I like to look for personally myself 1-to-1 or better. If I'm going to get 1-to-1 or better, great. Now here's where futures are really cool because you might come from a background of options, maybe. And if you trade options, you know that there's decay, there's other factors in options trading that can throw off the risk reward. So the chart might be, a 2-to-1 where I'm going to risk $1 to make 2 on like Tesla stock, for example, right? And I will enter on the trigger point and Tesla goes, my direction, kind of starts pushing towards my take profit. Then it comes back. And now my loss is a lot bigger than I thought because I picked the wrong contracts or the decay was really big. When it comes to futures, we don't have to worry about decay. I'm going to enter right here. If price goes up for my entry and I went long, then it's going to be I'm green. Right? Obviously, there's fees too, but generally I'm going to be green. If it goes a couple points my direction, you shouldn't lose money on that, right? And same thing on the short side. If it goes my direction, I'm shorting, right? I should be good. So it makes it easier. And so I think on futures, we can look at the charts and start to say, hey, like this risk reward doesn't need to be as good as maybe it was if I was trading options, if maybe that's where my background was. Maybe it's not, and this is not really relevant to you. But you could be good again with a 1-to-1 risk reward or a 1-to-1.5, something along those lines is totally fine. So don't think that you need to have insane risk reward. But I'll be honest, when you could risk less than you could look to make, it makes things a little bit easier mentally. And, obviously the win rates don't have to be insanely high. So we can adjust stop losses and we can have patience to let it work. Coming from options background, it's very easy to be impatient because you're like, I want to take the profits now because there's theta decay. Decay's coming. I got to get out. Like, relax, let price do what price does. Either it hits your take profit or it hits your stop loss. Doesn't matter. That's it. Let price do what price is going to do. Now, in terms of a scaling strategy, here's the last piece of, I think, really useful advice. Here is a way to approach things. You can have 3 take profits. You can have 2 take profits. You could just have 1 take profit. This is where we have experimentation. I would recommend that you start with 1 take profit. Okay, so your strategy tells you, I'm going to have my stop loss here and my take profit here. Okay, either the take profit hits or the stop loss hits. That's it. We log our trades. We get our data. Great. Now we're at this point. Once we've done all of this, okay, now we can start talking about scaling, because it's not as important, but it can be the icing on the cake to your strategy. For example, let's say you trade S&P futures and you look at a take profit that's 8 points away from your entry point. Okay, here is how I would structure something along those lines. That's my first take profit. My risk is maybe 6 points. So I'm going to risk 6 points. I'm going to make 8 points. That's a better than a 1-to-1 risk reward. Cool. But I don't want to cap myself there. Okay. Here is where we can utilize scaling to our advantage. At the 8-point take profit, I'm going to take 2/3 of my position off. Maybe it's 3/4. Maybe it's 9/10. I don't know. I like to take just over half of the position off at this point because, hey, we got our target. Let's lock in the majority of the gains. If it wants to keep going, great. I'm now going to move the stop loss of my remaining contracts to break even. And now at 12 points in my direction, I'm going to take off half of what I have left. So I take off 2/3. Now I'm going to take off half of what's left, or roughly, and maybe the contracts don't work perfectly. Take off, let's say you had 3 left. Take off 1 or 2 more. Doesn't really matter a ton at this point in time. But, again, that can scale up as you have larger sizing. And then at 20 points in my direction, I take the full thing off. Okay, so maybe I execute along those lines and I can bring my trailing stop loss off. That's just one example. So I'm risking 6 points to make 8+. I take off 2/3 at 8. I take off half of what's left at 12 points. And then I take off the rest of it all out at 20 points. Because if I get a 20-point move in my direction, that's amazing. I'm locking it in. Okay, or I guess I could, in theory, just bring my stop loss up even more. That's just one example of a way to scale. If that's helpful, great. If not, modify it to what might work better for you. But again, the whole point of this video is that, again, we didn't talk about what you need to do to where you have to put your stop loss and where take profit has to be. That's not that helpful, in my opinion. The systematic approach is. So, thanks so much for watching. Check out the sponsor of today's video. Any links, resources are linked up in the video description box down below with the sponsor link to Jigsaw Trading. Hope you guys enjoy. Share with a friend. Thumbs up button. Consider subscribing. And we'll see you in the next video. Peace.